morning everyone, myself Vanmati, Assistant Professor, Department of Bank Management in Tirthananada College. Today we are going to explore auditing and corporate governance. Auditing means to hear. Auditing means to hear. Today we are going to overview the introduction, audit process, objectives of audit, advantages and disadvantages of auditing, classification of audit, internal audit, internal control and internal check system, appointment and removal of auditors, corporate governance, environment and social, concept of CSR. Introduction of audit. Meaning, auditing means is a Latin word derived from the word adhere. Adhere means to hear. Audit is a systematic examination and evaluation of financial record to accurate the financial statements and organizational structure to detection the control the errors or fraud. In simple terms, auditing evaluates the checking of books of accounts in fair view. History of audit. In 1840 to 1920, audit is a financial accuracy normal state. In phase 2, 1920 to 1960, standard emerged in auditing became more formal. In 1960 to 1990, resolution increased in auditors focused in internal. In phase 4, 1990 to till date, technology risk-based auditing transferred the process. Next, what is the difference between bookkeeping, accountancy and audit? These we have to know very important. In bookkeeping, first we are going to do the journalizing. Next, post the ledger, totaling the ledger accounts. Next, balancing ledger. In accountancy, rectifications of errors, preparing trial balance, trading and profit and loss. In auditing, these two after the finishing we do the auditing. In checking the verification of work done by the auditor. Who will check? Done by the auditor. Two types of. Next we are going to see objectives of audit. There are two types of objectives, primary objectives and secondary objectives. In primary objectives, to express the opinion on whether the financial statements give the true and fair view of the financial position and performance of the organization. In secondary objectives, detection and prevention of errors and fraud, verifications of assets and liabilities, checking compliance with the laws, accounting standard and internal policies, accessing the effectiveness of internal control system, assisting management and decision making by providing the insight of financial practices. Next, advantages and disadvantages of auditing. In first we are going to see the advantages only. Ensures accuracy and reliability of financial statement, detects and prevents errors or fraud, build the trust of shareholders, investors and creditors, improves the internal control system, helps to ensure the regularity compliance, facilitate better decision making with verified data, increase the chances of getting loans or attracting the investor. And we are going to see the disadvantages. Can be expensive, especially for small business. Time consuming, may interrupt the normal business activities, may not detect all frauds, especially with collusion. Risk of over-reliance on auditors by the management, involves the subjective judgment which may vary between the auditors. In rare cases, auditors may affect the unethical or overlooked issues, adds administrative burden to the organization. Next, classification of audit. There are four classifications. First, on the basis of organizational structure. Next, we are going to see the type, purpose and approach. First, organizational structure. Then statutory audit. Audit required by law, conducted by annually qualified by the auditors. Involuntary audit, not legally required, done by the choice of the organization, usually done by the firm's sole proprietorship for the better control and credibility on the basis of time. In what time we will do the audit? Next we are going to see in interim audit, conduct between two financial year, quarterly and halfly, helps management in the mid of the year financial review. Financial audit, it done by the annually at the end of the accounting period. Next, continuous audit, conduct throughout the year in regular intervals, suitable for the large organization with complex transaction. Occasional audit, done by the needed, often used specifically investigation in small firms. On the basis of purpose, internal audit conducted by the internal staff, internal audit team focused on improving the internal control compliance of operational efficiency. External audit performed by the independent auditor, not connected to the organization. It comes from other companies. Objectives is to give an opinion to fairness of financial statement. Tax audits required under tax laws. For example, Income Tax Act ensures proper tax compliance and reporting. Cost audit examines the cost accounting records, ensure cost efficiency that costing methods follow standards. Management audit evaluate managerial efficiency and effectiveness, focus on decision making, planning and internal policies. Social audit reviews the companies of social responsibility and impact on the basis of approach. Balance sheet audit focus on mainly verifying the items on balance sheet, checks accuracy of assets and liabilities. Transaction audit focus on detailed checking of transaction throughout the year. Internal audit, internal control and internal check system. In definition, independent review of operations, system to ensure achievements of objectives, division of duties to avoid the manipulation. Purpose, evaluate and improve the internal system, ensure accuracy, compliance, efficiency, prevent fraud errors throughout the mutual checks. Conducted by who conducted the audit? Internal auditors, all the levels of management and staff, operational employee. Nature, evaluate, preventive and detective, preventive. Scope, board, entire organization, organization wide, mostly in accounting operation. Frequency, periodic or continuous, ongoing, continuous. Appointment and removal of auditors. First, we have to see the appointment of auditors. First auditor. The first auditors of a company appointed by the board of directors within the 30 days of incorporation. Subsequent auditors. Subsequent auditors are appointed by the stakeholders at the time of annual general meeting at the specific term. Casual vacancy. In case of casual vacancy, the board of directors appointed auditor. Removal of auditor. Shareholder resolution. An auditor can be removed by the shareholders throughout the specific resolution at the general meeting. Notice to auditor. The auditor has to right to make the representatives and receive the notice of the purpose resolution. Regulatory approval. In some cases, regulatory approval may be required for the removal of an auditor. Now we are going to see the corporate governance introduction. The corporate governance refers to the system of rules, practice and process by which a company is directed and controlled. It involves the balancing interest of various stakeholders, including the stakeholder management, customer supplies of the community. Conceptual framework. The conceptual framework of the corporate governance encompasses the various theories and models and that guide the governance practices of companies. Some key theories and module include agency theory. Focus on the relationship between the principals, stakeholders and agents and managers. Stakeholders theory emphasizes the most important of considering the interest of all